Over the last few years, crypto has mostly been treated like a speculative side market, something separate from traditional finance. But lately, the headlines are starting to connect in a very different way. Because while cracks are forming across the consumer economy, major institutions are quietly positioning for a digital asset future, and the speed of that transition may be accelerating. This content is for informational and entertainment purposes only and is not financial advice. Always do your own research before making any investment decisions. Welcome back to Ledger Pulse. New data, highlighted by the Kobisi letter, shows serious U.S. credit card delinquencies climbed to 13.1% in Q1 of this year. That's just below the peak reached after the 2008 financial crisis. Student loan delinquencies also moved sharply higher. Auto loan delinquencies just hit record levels. In other words, financial pressure is building fast across consumers. And historically, moments like this tend to reshape investor behavior. When confidence weakens in the traditional system, capital starts searching for alternatives: hard assets, scarce assets, and increasingly, digital assets. You can already see that shift beginning underneath the surface of the crypto market. New on-chain data shows wallets holding at least 100 Bitcoin increased more than 11% over the past year. There are now over 20,000 large Bitcoin wallets. Not during easy conditions, not during peak hype, during uncertainty. That says a lot. Large holders usually accumulate when they believe the market is mispricing the future. Meanwhile, the blockchain backer says Bitcoin's biggest challenge right now sits around the $82,000 level. Historically, post-capitulation recoveries often stall near these resistance zones before the next major expansion begins. So while retail traders keep debating every short-term move, larger players appear focused on positioning ahead of what could come next. Now this is where the conversation starts getting much bigger than crypto prices. According to reports shared by Bloomberg, the SEC is preparing a potential innovation exemption tied to tokenized securities. If approved, this could open the door for blockchain-based versions of stocks to trade through digital infrastructure, and suddenly the line between Wall Street and crypto becomes a lot thinner. Think about the implications: 24/7 markets, faster settlement, fractional ownership, global accessibility, and reduced reliance on traditional intermediaries. This is the type of shift the crypto industry has been talking about for years. Except now, regulators appear willing to engage with it instead of blocking it outright. That changes the tone completely. Because once tokenization enters the mainstream conversation, infrastructure becomes the real battleground. Not memes, not hype cycles, infrastructure. Fresh on-chain data shows XRP whale wallets holding at least 10 million tokens now control more than 68% of circulating supply. That's the highest combined balance since 2018. Smaller wallets have also continued accumulating, with more than 332,000 wallets now holding at least 10,000 XRP. And the timing stands out. This accumulation is happening during consolidation, not euphoric breakout conditions, which suggests conviction. Now zoom out for a second. If tokenized assets become part of the future financial system, then networks designed around liquidity movement and fast settlement naturally become more relevant. That's why XRP keeps finding itself in these discussions, not because global adoption is guaranteed tomorrow, but because the broader market structure is moving closer to the exact environment Ripple has been building towards for years. And whether people love XRP or hate it, the infrastructure narrative around it is becoming harder to dismiss. Another major signal came out of Minnesota. The state officially enacted legislation allowing banks and credit unions to offer crypto custody services beginning August 2026. Then another headline drops. Reports say Standard Chartered is looking to fully acquire Zodia Custody and fold it deeper into its digital asset operations. This is how institutional adoption usually happens, not through dramatic announcements, through infrastructure expansion, step by step, layer by layer. Because before trillions of dollars can comfortably move into digital assets, institutions need secure custody, compliance frameworks, and operational control. Now banks are building exactly that, quietly. And while all of this develops, XRP investment products are starting to attract serious capital. According to CoinDesk data, XRP ETFs just recorded roughly 60 million in weekly inflows, the strongest week of 2026 so far. Cumulative inflows also pushed to new highs. That doesn't mean institutions suddenly control the XRP market, but it does reinforce the direction capital is moving. Because when you combine ETF inflows, whale accumulation, tokenization discussions, regulatory softening, and expanding custody infrastructure, it starts looking less like isolated headlines and more like a coordinated transition into digital finance. Right now, two different stories are unfolding at the same time. The traditional financial system is showing visible stress, and crypto infrastructure is becoming more institutionalized by the month. Banks are adapting, regulators are evolving, capital is positioning. The market may still look volatile on the surface, but underneath it, the foundation is changing. And if tokenization truly becomes the next major financial trend, this next cycle could look very different from anything we've ever seen before. So here's the question. Which asset do you think benefits the most if the financial system fully embraces tokenization and blockchain infrastructure? Bitcoin, XRP, Ethereum, or something else entirely? Drop your thoughts below. If you enjoyed this breakdown, make sure to like, subscribe, and turn on notifications to stay ahead of the curve. Till the next one, stay sharp.